Thank you for joining me. I'm Juan, lead trader and founder of ProsperiTrade. In this quick short video, we're going to take a look at Zoom. It's had a major drop. Is it a buying opportunity or should we leave it alone? Stay tuned and let's find out together. So if we look at the chart, as soon as the earnings came out, it dropped from $347 down to $289, almost $58, down 16%. And what was the reason for that? What was the news that caused this to drop? If we look at the earnings and we just look on the surface, it doesn't look terrible. For example, we have the earnings per share. They estimate it to be $1.16, and it was actually $1.36, which is a 17% beat. For the revenue, they estimated a $990 million and actually reported over $1 billion. It's the first time they reached $1 billion. It was a 3% surprise. So why the big drop? If you just read these two things, why such a big drop? Many people are starting to think that they over-anticipated or gave too much growth. This company had major growth with the pandemic. So if we look at their revenue, they went from 60 million to 151 million to 330 million to 622 million to over 2 billion in revenue. So that's just major growth. You're talking about 50% growth. So it's been major growth over the last few years. And part of this major jump here from 332 million to 622 million to 2 billion was because of COVID. This company got high evaluations and high DCFs. You know, when they create a DCF, they base it off of free cash flow, potential revenue growth, and the numbers can change. If you, for example, put revenue growth of 25% over the next few years, and then you get poor growth and it drops to 15%, well, that's a big difference in the intrinsic value that you estimate. So let's look at some multiples. As far as value, right now, and we just did a video on EV/EBITDA, enterprise value divided by EBITDA, and we discussed when we do those numbers, we get a ratio, we get a metric, and we can compare it to other companies in the sector to see if it's overvalued. So the EV/EBITDA here, and you can check out the video we just did on EV/EBITDA, and we described it, it's 61. Now you compare that with their sector, 16. So you see how expensive it is. Now, if this company is growing and they're continuing to grow, and if they had not slowed down, people are going to be willing to pay for this high price, this high PE ratio of 74% compared to the sector medium of 25%. Price to cash flow, 59 to 22. So it's just an overall real expensive company. So other signs that this company is starting to slow down, they have their customers that are spending over $100K a year was up 131%, but that's down from 160% from the previous quarter. Then another metric they use, or another estimate that they have, is their business with 10 or more employees. So that's where they go after the small business, and that's a big portion of their revenue. That's up 30%, but the previous quarter, it was up 60%. So that's cut in half, going down. I think what a lot of analysts are doing, a lot of people that are invested in this company, they saw this massive trend, this massive movement. And let's just take a look at the 5-year chart here. We see that they've IPO'd in 2019, and since their IPO, they're up 366%. But now, if you take the last year, they're down 36%. The last 6 months, 29%. The last month, 23%. And then the last month, 5 days, which is the last few days, down 15% just in a couple of days. This company did well from the IPO, and now is it coming back down to reality? Are people saying that this massive train now is finally slowing down? And I think that's what they're anticipating. They're saying, okay, we're seeing a big slowdown. We're seeing that companies that have 10 or more employees that were using Zoom are down half, 50%, went from 67% last year down to 36%. Companies that were spending over 100K, it went down from 160% to 130%. So is this the turnaround? And most people feel like it is. It is a turnaround. It's a shift in momentum. And this is the downward trend now. Now it's going to go back to reality. All these expensive metrics are not justified anymore. I think that's what's going on now. But let's take a look at our own numbers and decide if this is a buying opportunity or we should just stay away and watch it from the sideline and wait for the next quarter. Maybe wait for the next quarter to see how their growth is going and kind of wait a few quarters and see if there's a consistent growth. So we're going to take a look at some numbers now. This is usually what I call kind of like my first quick line estimate to see if this company is even worth taking a deeper dive in. I have a quick evaluation based off of free cash flow, some estimates, and then I get an intrinsic value and I decide, okay, yeah, it's worth taking a second look. So I have 3 different DCFs that I use. I use this one, which is really quick because it's just free cash flow, financial liabilities, cash, and their shares outstanding, and it gives you a free cash. It gives you a fair value per share. When I did the fair cash flow analysis, I took 2018 free cash flow, which was $9 million. Then it jumped 116% to $20 million. Then it jumped 447% to $113 million. Then it jumped 1,119% to $1 billion. This is how easily this can be manipulated. I gave a pretty conservative 25% growth, 24%, 24%, 24%. I don't think we're going to see numbers like this anymore. And it gives me a fair value of $316, which is a 9% possibility for profit. But let's say somebody said, I think it's still going to grow at 55%. Now that number becomes $388. This guy says, yeah, it's going to keep going. It went 100%, 444, 1,000%. I think it's going to go up 124% in year 2023. So now look, $683. So that's how some people get these huge DCFs, by looking at this and saying, oh, I think it's going to continue. But that's just not realistic. I think it's a good company. I think they have their, some potential catalysts coming up with their Zoom phone business and things of that nature. So they have different things in place, but I don't think that they're going to continue to grow the rate that they were growing, and they're about to slow down. They're going to slow down. That's what a lot of people are anticipating. With this one, I say, okay, look, there's some potential, and let me do a more detailed DCF where I take in capital expenditures. I bring in other factors to give me a little bit more of an accurate number. If I want to take a deeper dive, I have another DCF that gets even deeper, and it also forecasts a bear thesis, a base thesis, and a bullish thesis. So let's take a look at my other DCF. Okay, so for this DCF, I take their revenue and their revenue growth, which has been 147%, 118, 88%. I take their cost of revenue, I add research and development, admin fees, and other. So you see it's a little bit more detail. I add their EBIT, depreciation and amortization, the capital expenditures, current assets. I put their cash and short-term investments, total current liability, net working capital. In 2022, I think the revenue growth can still be a modest 35%. You compare that to over the last few years, 147%, 118, 88, 325. I don't think they're going to grow that much. So I give them a growth of 35%, then 23%, then their 20s. Then I bring it down to 19, 18, 20. Like any other big business, you anticipate that it's going to slow down. You add the EBITDA and the percentage of revenue. Their average has been 26.4%, so I kept it at about 25. Capital expenditures and their percentage of revenue, I kept the average. You take their tax assumption, the discount rate, then you enter their current value of cash and cash equivalents, their value of debt, how many shares do they have diluted trading, and we get a fair value of $262. So now I added this up here, the fair value of $262. The last one that we did, the free cash flow, the first one was $316. I take the average of those two, which is $289. Its current price is $288. So there's a 0% upside. On the free cash flow is $316. So this tells me that right now, based off of the numbers, that it's fairly valued. And I don't have enough information to go further. So if I just base it off the free cash flow, then I would be bullish. But when I take into account everything else, then I'm neither bullish or bearish. I just don't know. I think really I need more information. I need to, because you see the difference, from jumping from 30% free cash flow growth to 50% cash flow growth the second year, and 50% or 150%. I mean, it makes the valuation go from $316 to $480 to $600. So it's a big difference. So right now, they were growing. If we would have done this maybe a couple of quarters ago, it would have been justified. You would have thought that they were going to continue to grow at that rate. I never got into it. I thought it was really expensive when it was above $400 or $500. It caught my interest when it dropped down to $288. But even looking at these numbers and putting it together, I'm going to stay away from it at this time. I don't recommend you buying it at this time. It can turn around and spike, or it can continue to drop. I don't know. That's the problem. And if I don't know, I don't think it's worth the risk. I would say I need a couple of quarters, and I need to see how their growth revenue goes over those next few quarters, and then do another DCF based off of the next year of revenue and revenue growth. I just think right now it's just not enough. I think they're slowing down. Small businesses are using them less. Companies that are spending over $100,000 a year on Zoom are using them less. So they may come out of this with their Zoom phone and other things they anticipate to have, and that may bring another stream of revenue. But it's just too much unknown for me, and it's a no buy for me. I'm staying away from it. Thank you for watching this video. If you enjoyed it, please subscribe, comment, hit the like. We have more videos coming. We have a few swing trade alerts that I'm excited about. So please subscribe, please hit the like button, and thank you for watching. See you on the next video.